Welcome to the Deep Dive. We're here to cut through the noise, get you some solid insights, maybe a few surprising facts, and hopefully keep you listening.
That's the plan.
So today we're diving into this really fascinating money paradox. You have these supposedly geniuses, finance types, executives who somehow end up broke.
Right. And then on the flip side, you get someone like a humble janitor who, well, quietly builds up a multi-million-dollar fortune.
Exactly. It sounds completely backward, but it happens, and it tells us a lot.
It really does. And that's kind of our mission for this deep dive. We've gone through a whole bunch of sources, articles, research, some really amazing personal stories, all looking at the psychology of money.
The why behind it all.
Precisely. We want to pull out those key nuggets, help you understand why we think and act the way we do about our finances. The goal is, to figure out how to make decisions that actually work for you.
Okay, so let's set the scene. Our sources talk about this one tech executive. Super smart guy, designed key Wi-Fi router parts, patented stuff, wildly successful.
And love to show it, big time.
You're like carrying thick wads of $100 bills, apparently threw $1,000 gold coins into the ocean. Just guess.
Wow, just for fun.
And there's this story about him smashing a $500 lamp in a hotel room. And when the manager came up, he just peeled off $5,000 and was like, there, we done.
You'd think someone like that, with that kind of success, is set for life, right?
You would. But the story ends with him going broke. Completely broke.
Which brings us to the other side of the coin, Ronald Read.
Right. Ronald Read, his Wikipedia page literally starts, American philanthropist, investor, janitor, and gas station attendant.
Doesn't exactly scream Wall Street genius.
Not at all. Lived in a tiny $12,000 house, chopped his own firewood, worked those jobs for decades. But when he died at 92...
He left behind, what was it, over $8 million?
$8 million. All donated to charity. No lottery win, no rich uncle, no complex schemes.
It's saving, investing in solid blue-chip stocks, and waiting for decades.
Letting that compounding work its magic. And these two stories, they just perfectly illustrate the core idea here, don't they?
Absolutely. That doing well with money, it really has very little to do with how smart you are, like IQ smarts. It's almost entirely about how you behave.
It's a soft skill. Seriously.
It is. And it's not just these extreme examples. Think about Richard Fiscone, hedge fund manager, Harvard-educated, University of Chicago MBA, had this massive 18,000 square foot mansion in Greenwich.
Sounds like he made it.
He did, for a while. But he also went bankrupt. Borrowed heavily, levered up during the 2008 crisis, got wiped out, pushed his luck too far.
So even the pros aren't immune.
Yeah.
It really hammers home that financial success isn't about the fancy degree or the complex models. It's discipline, habits.
Yeah, everyday habits, emotional control, patience, stuff like that.
What's also wild is how much our own personal history with money shapes everything. Even if your experience is just this tiny sliver of the global financial picture.
Like 0.000000001% of what's happened.
Right. That tiny sliver can dictate, say, 80% of how you think the whole financial world works. Why does our own little story have such a massive grip on us?
Well, it's because personal experience is just so vivid. It's real to us in a way abstract data isn't. So if you grew up when inflation was sky high,
you're probably going to be wary of bonds your whole life, huh?
Pretty much. Even if current conditions make bonds look, reasonable, or flip it. If the stock market was roaring when you were, say, in your early 20s.
You're more likely to jump into stocks later on.
Exactly. There's research on this Malmendier and Nagel. They found people's lifetime investment choices are heavily anchored to what the market did during their early adult years. It's less about analysis and more about, frankly, the luck of the draw when and where you happen to come of age.
That really puts things in perspective. And it explains some cultural differences too, right?
Yeah.
Like that story about the Foxconn worker's nephew.
Oh, yeah, that was powerful.
Yeah.
From a New York Times comment section, people in the West were understandably upset about the working conditions, calling it a sweatshop.
But then this nephew writes in and says, look, for my aunt, working at Foxconn was actually a step up.
A step up from prostitution? It just completely flips the script on our Western idea of poor conditions, because the starting points, the frames of reference are just so vastly different.
It shows financial decisions aren't just made on spreadsheets. They're made, at the dinner table, maybe in a meeting, but they're driven by personal history, ego, pride.
Odd incentives, yeah. Think about lottery tickets. Americans spend more on lottery tickets than on movies, video games, music, sports events, and books combined.
Which is mind-boggling. And who buys the most? Usually lower income folks.
Mathematically, it looks irrational, right? The odds are terrible.
Totally. But one person explained it this way. For many, It's not an investment calculation.
Sure.
It's paying for a dream, a tangible bit of hope for, the good stuff that feels out of reach otherwise.
And when you see it like that, it's not about cold logic. It's about meeting a need driven by a life story.
Okay, so behavior is king. Let's switch gears a bit to something related but maybe less obvious. The power of time. Compounding.
Yes, compounding. The eighth wonder of the world, supposedly. But it's so counterintuitive. Even brilliant people like Bill Gates, apparently, underestimated its sheer scale early on.
I love the Ice Age analogy one of our sources used. You think, how could a tiny change freeze whole continents?
Right, it seems impossible. But it starts small. Summers that are just a little bit cooler, so not all the winter snow melts.
Leaving a base layer of ice.
Exactly. Which makes it easier for more snow to stick the next year. That snow reflects more sunlight, which cools things down even more.
And bam. Before you know it, you've got massive ice sheets. Huge results. Not from some massive force, but from consistent small gains building on themselves.
And that is precisely how wealth building works. Take Warren Buffett. His genius isn't just picking stocks, though he's obviously good at that.
It's how long he's been doing it.
It's longevity. He started investing around age 10. He's still at it in his 90s. Something like, $81 billion of his $84 billion net worth came after his 65th birthday.
That's insane. Most of his wealth came after he qualified for Social Security. That's the power of just waiting.
Now compare him to Jim Simons at Renaissance Technologies. Phenomenal investor.
Yeah, his returns are legendary, right?
Yeah.
Like 66% a year since 88,
Yeah.
compared to Buffett's 22%.
Exactly. Way higher annual returns. But Simons is worth maybe $21 billion, give or take. Much less than Buffett.
Why? Just because he started later?
Pretty much. Simons didn't really hit his stride until he was 50. He's had less than half the time for that incredible compounding to work its magic. It just shows skill matters, but time. Time is the multiplier.
Our brains just aren't wired for exponential growth, are they? That slow build, then the explosion, it feels unnatural.
Totally. Which is why one author joked the best investment book should just be called Shut Up and Wait.
Probably true. The big lesson isn't just that compounding works, but that patience might be the most crucial yet hardest part. That's the difference between Ronald Ree and that exec.
Okay, so getting wealthy involves patience and letting compounding do its thing. But what about staying wealthy? That seems like a different skill set altogether.
Yeah, our sources suggest there are tons of ways to get rich luck. Skill, risk-taking. But staying rich, that boils down to something simpler, maybe harder.
A mix of what? Frugality and paranoia.
Basically, yeah. Think about Jesse Livermore. Stock market legend back in the day. Made the equivalent of $3 billion betting against the market in the 1929 crash.
Wow. Genius timing.
Absolute genius.
Yeah.
But just 4 years later, he'd lost it all. Overconfidence, too much debt. He just kept pushing his luck until it ran out.
Getting rich is one thing. Staying rich requires humility, maybe a healthy dose of fear.
And remember Rick Guerin, the third Beatle of investing alongside Buffett and Munger?
Oh, right.
Hey.
Buffett said he was just as smart as them.
But he was in a hurry, used leverage, borrowed money. Then a market downturn hit in the 70s, margin calls came.
And he was forced to sell his Berkshire Hathaway stock at the worst possible time.
Exactly.
Yeah.
He missed out on astronomical gains because he couldn't survive the downturn.
Yeah.
He was great at getting wealthy, but not at staying wealthy. Needed that survival mindset.
Which means not just chasing the absolute highest returns.
Right. It means prioritizing being financially unbreakable, maybe holding more cash than seems optimal during good times. That cash isn't just sitting there. It's buying you the ability not to sell your investments when things get scary. It lets compounding continue uninterrupted.
So you have to plan for the plan not going according to plan, because life throws curveballs, 9/11, recessions, pandemics.
That's your margin of safety. You need that buffer.
And it ties into this idea that nothing's free, right? Especially in investing.
Definitely. Success has a price, but it's not paid in dollars usually. It's paid in, like volatility, fear, doubt, uncertainty, regret.
And you have to see that as the fee for admission, the cost of potentially getting good returns, not a fine for making a mistake.
Like, look at the S&P 500's long-term returns. They're great. But during that whole period, the market spent most of its time below its previous all-time high. Drawdowns are normal. That's the fee.
And if you try to dodge that fee, try to time the market to avoid the dips.
You usually end up worse off. Investors notoriously underperform the actual funds they own because they panic sell low and FOMO buy high. You can't escape the fee.
Okay, so beyond behavior and time, there are these sort of hidden forces at play too, like tail events.
Yeah, this is fascinating. The idea that a tiny number of extreme events, the tails on the probability curve, drive the vast majority of results. In business, investing, even art collecting.
Like that art dealer, Heinz Berggruen, he bought tons and tons of art, almost like an index fund approach.
Right. He didn't know which specific pieces would be masterpieces, he just bought broadly. Most of it ended up being worth little.
But a few pieces, the Picassos, the Klees, the Matisses, those were the tails. They became incredibly valuable and made his entire collection, his entire fortune, basically.
It shows you can be wrong or average most of the time, as long as you
Stop.
capture those few huge winners. Yeah, you have to be okay with a lot of stuff not working out.
And it's the same in investing. Buffett said something like he made most of his money on just 10 out of maybe 500 stocks he's owned.
Wow, only 10.
And studies show this across the market. Like one JP Morgan study looked at the Russell 3000 index. 40% of those companies lost 70% of their value permanently. Ouch.
Yikes.
But a tiny fraction, maybe 7%, were mega winners that drove almost all the index's overall gains. Tails drive everything.
It reminds me of that Napoleon quote about military genius.
Oh, what was it?
The man who can do the average thing when all those around him are going crazy.
Ah, right. Keeping your head during panic.
Yeah. Your long-term returns often depend less on the calm years and more on how you react during those moments of like sheer terror in the market. Can you just stick to the plan? Can you avoid doing the crazy thing?
So embrace the fact that most things might not work out spectacularly, but a few things might work out incredibly well, and that's enough. Just stay in the game.
Which leads to maybe the ultimate point. What's the real payoff for all this financial effort? What's the best thing money can buy?
And it's probably not what most people think. It's not the fancy car or the huge house.
Yep. The highest dividend money pays, according to our sources. It's the ability to wake up and say, I can do whatever I want today.
Control. Freedom.
Exactly. There was this psychologist, Angus Campbell, who researched happiness. He found the most reliable predictor wasn't income or house size or job title. It was having a strong sense of controlling one's own life.
That makes so much sense. Money's greatest value isn't buying stuff. It's buying control over your time.
Yeah. The ability to take a sick day without worrying. To tell your boss no occasionally because you have an emergency fund. To wait for the right job after a layoff, not just the first one. That's real wealth.
I remember the story about someone who interned at an investment bank, loved the actual work, found
Yeah.
it stimulating, but the hours were insane and totally unpredictable. The rule was basically, if you don't show up Saturday, don't bother coming Sunday.
Oof. That's rough.
He lasted a month. Because doing something you enjoy, but on a schedule you absolutely cannot control, feels just as bad as doing something you hate. It's that feeling of reactance. We push back hard when our autonomy is taken away.
Derek Sivers, the entrepreneur, he tells a great story about this too.
Oh, yeah.
He was making like $20K a year, lived super cheap, saved up $12,000. At 22, he quit his job to be a full-time musician.
That took guts.
Totally. And years later, after he'd sold his company for millions, someone asked him when he got rich. He said, I was already rich when I was 22 because that $12,000 bought him his freedom. That was the moment.
It's that modern paradox, isn't it? We're richer materially than ever before, certainly compared to the 1950s, but are we happier?
Often not, yeah. Because maybe we've traded too much control over our time for just more stuff, bigger houses, fancier cars, but less autonomy.
And when you look at studies of the elderly, people who've lived long lives, like in Carl Pilmer's research,
What do they value looking back?
it's never chasing the next dollar or keeping up with the Joneses. It's overwhelmingly about quality friendships, having a purpose, and having unstructured time, especially with family. Control over their time, again.
Really puts it all in perspective. Okay, so pulling these threads together, what's some practical wisdom we can take away?
Well, first off, don't try to be perfectly coldly rational with money. Aim for pretty reasonable.
Reasonable, why not rational?
Because reasonable is realistic. It acknowledges we're humans with emotions, biases, weird histories. Reasonable is something you can actually stick with long term, and sticking with it is key.
Like Harry Markowitz, the Nobel Prize winner in economics.
Yeah.
He didn't use his own complex portfolio theory for his retirement savings.
Nope. He apparently just split it, 50-50 stocks and bonds, because he wanted to minimize future regret. He was being reasonable for him, not mathematically optimal on paper.
Find a strategy you can commit to, something you can live with through thick and thin.
Exactly. If you kind of love your strategy, you're far more likely to endure the inevitable rough patches. And endurance is what lets compounding happen. Remember, Over long periods, like 20 years, the U.S. market has historically always made money. Staying invested is the game.
We also have to embrace surprise, right? Except that the future won't look like the past.
Definitely. As Scott Sagan said, things that have never happened before happen all the time. History teaches us about human behavior, greed, fear, but it's not a precise map of future events. Think about things like 401ks, venture capital, index funds. These change the landscape.
And Daniel Kahneman's insight. The real lesson from surprises isn't what surprised us, but that the world is surprising.
Right. And we also suffer from the end of history illusion.
Which is?
We tend to recognize how much we've changed in the past, but we underestimate how much will change in the future. The person you are today making financial plans is not the same person who will be living with those plans in 20 or 30 years.
So avoid extreme plans, like planning to live on practically nothing or work yourself into the ground forever.
Exactly. Those extremes maximize the chance of future regret. Balance promotes endurance. And be willing to change your mind. Don't cling to goals made by a different you just because of sunk costs. Cut bait and move on.
Okay, another big one. Define your own game.
Crucial. Remember the man in the car paradox. You see the fancy car, you want the respect you think it brings.
Like, you don't actually want the car, you want the admiration. And the irony is the person in the car isn't thinking about you, they're thinking about themselves. Or maybe the next car.
And you're taking cues from someone playing a completely different game. You see their spending, but you don't see their goals, their debts, their worries. True wealth is often invisible. The savings, the flexibility.
So you need to know your time horizon, your risk tolerance, your goals, and filter out the noise from people playing different games.
Maybe even write down a little mission statement for your investments. Something simple like, I'm a long-term passive investor aiming for growth over 30 years. It helps keep you anchored.
Lastly, let's touch on pessimism. It always seems to sound smarter, doesn't it?
It really does. Pessimism is more captivating. It grabs headlines. Optimists sound like sales pitches. Pessimists sound like they're trying to help you.
But for building wealth, optimism's the belief that things will generally trend upward over time. Despite setbacks, that's usually the winning bet, isn't it?
Generally, yes. Pessimism resonates because loss aversion is wired into us. Bad news feels more urgent. And since money affects everyone, bad financial news gets amplified.
Plus, pessimists often just extrapolate current negative trends without considering how markets and people adapt, how problems get solved, like predicting we'd run out of oil before fracking came along.
Exactly. Progress is slow, incremental, often boring. Setbacks are sudden, dramatic, and make news. But over the long haul, optimism about eventual solutions and growth has paid off.
Okay, so let's boil this all down. Final nuggets of wisdom for everyone listening.
All right. First, humility in success, compassion in failure. Luck and risk are always lurking.
Less ego, more wealth. Saving is simply the gap between your ego and your income.
Manage your money to help you sleep. Peace of mind is a return too.
Think long-term. Compounding needs time. Decades, ideally.
Be okay with lots of things going wrong. Tails drive returns. You don't need everything to work.
Use money to buy control over your time. That's its highest and best use.
Be nicer, less flashy. Kindness earns more respect than horsepower.
Just save. Save for specific goals, sure, but also save just because.
For the surprises.
See volatility as the fee for admission, not a fine for being wrong.
Worship room for error. Margin of safety. Endurance is everything.
Avoid financial extremes. You will change your mind later.
Like risk, absolutely. But fear ruinous risk, the kind that takes you out of the game permanently.
Define your game. Know why you're investing and whose signals you should ignore. And respect the mess. Smart people do weird things with money. It's okay. Be reasonable, not purely rational.
So how do we apply this stuff in our own lives?
Well, for my partner and me, a big one is prioritizing independence, way over getting rich quick. Even as income grew, we consciously tried to keep our lifestyle pretty similar to when we were younger. That keeps the savings rate high.
Yeah, and we definitely made some irrational choices that felt reasonable, like paying off our mortgage years ago, even though the interest rate was super low. Mathematically, maybe dumb.
Right, you could have invested that money for a potentially higher return.
Exactly. But the psychological freedom, knowing the house was ours outright, that was worth way more to us than the potential extra percentage points. We sleep better.
We also keep a fair bit in cash, probably more than a typical advisor would suggest, maybe 20% outside the house value.
Same here. That cash isn't about earning returns. It's about never, ever being forced to sell stocks at a bad time just because we need money. It's independence insurance. It protects the long-term compounding.
And the core strategy, just boring low-cost index funds, invest consistently, automatically every month for decades, and then just leave it alone.
Pretty much. High savings rate, patience, optimism about long-term global growth, and letting time do the heavy lifting. It works for us because, like we said, good decisions aren't always the ones that look best on a spreadsheet. Sometimes you got to choose happy over right.
So the final thought for you, the listener, what's your game? What does being good with money actually mean for you?
And are you focusing enough on those unseen returns like control over your time, peace of mind? Are you aligning your money with what genuinely makes you happy?
Thinking about that might just lead to the greatest wealth you'll ever find.